My venture capital fund invested in 4 different unicorn startups. That's $1 billion. I've studied the data and realized that they all used variations of these critical strategies, and here's how they did it. The first strategy at these companies all radically changed what they did over the course of the business. So $1.4 billion, that's how much this company TripleLift sold for in cash to private equity. It wasn't even for the whole company, it was just for a majority of the shares. And this company started out as like a browser extension to be able to buy and sell stuff on Pinterest. They pivoted 4 different times in the first 6 months of the company, and then they became a ad exchange for video ads, native video ads. Doesn't even matter what that means, but they weren't scared to completely change. Now, there are 3 different types of ways that you might think about changing the company. One I call a nudge. That's just a little change where maybe you change the product, you change the market a little bit or the way you sell, but it's still fundamentally the same company. The second is called a pivot, and we've all heard that word. That's a bigger change. For example, you go from selling to businesses B2B to B2C in order to find a better product market fit. And the third, the fun one, this is what TripleLift did, was you completely change the company. You decide that what you're doing ain't working. You're brave and you say, let's just find something new. And that becomes the $1 billion idea. Now, the second strategy that these unicorns used was they all said no to investors at some point in the history of the company. Now, of course, running out of money will kill your company, but so can taking the wrong money from the wrong investors. And all these companies had trouble raising their early rounds, but they all said no for good reasons. Now, the first reason they might have said no was because they were just fundamentally misaligned about the vision of the company. Now, maybe they agreed, the founder and the investor, on the first 6 months, 12 months of the plan, but once things start getting rolling, there's lots of opportunities and also lots of challenge. It's critical that they be aligned, and if they're not, there's going to be no end to the grief, to the tears. You're going to spend all your time fighting with your investors, and that can kill any company. The second reason is about valuation. So when an investor offers you money, they say, we think the company is worth this. That's what percentage of the company we get. And if they think that valuation is too low, it's not just about greed. That's telling you that they don't have such high expectations for the company. They just want to have a lot of it so that when it sells for not so much, they'll still make enough money. But if you have your sights on $1 billion, then they should be willing to put more money in at a better valuation because they're along for the ride to a unicorn status with you. And the third is control. So sometimes investors, especially if they're putting in just not so much money, they want to have a seat on your board of directors or the rights to approve or to block certain types of things you do. That's a really bad sign because when you're investing in an early stage in the company, they are betting on the founder. Founders, you are the company. And if they're trying to get too involved, that just says they don't trust you, they don't back you. It's probably the wrong investor for you. I'm glad you stuck around for the third thing because it's really important and people don't think about it. Now, when you're first raising your first rounds, sometimes investors will ask you, who are you going to sell to or how much are you going to sell for? And those are nonsense questions because you don't really know until you have offers on the table. And here's 2 things really to keep in mind. Number 1, don't do it if the offer is too low. And yes, of course, that's about valuing your company properly. But it's also about the terms of that offer. Is it stock versus cash, where the stock, maybe you don't know what the stock is worth or you don't have control over it? Or maybe they'll give you the money, but you have to agree to stay on for 2 years and you're going to have an absolutely miserable life. Or maybe you know that you have some development coming right around the corner that's going to really increase the value of the company and they don't know about it or they don't believe in it and you should hold out for more. And the second way to tackle this is to actually have an auction process so that there's some FOMO and competitive bids. We all know that works in real life, right? So this one company hired an investment bank and they actually ran a process. In the end, they turned down the offer that actually was valued at the most for the reasons that I just talked about. In the end, they decided that they wanted to take an offer that had a slightly lower dollar value, but had better terms in terms of being all cash and not having to stick around. And it just made for a much cleaner exit, a much better exit. So it's a true unicorn and not a unicorn with a little asterisk next to it. So there you have the 3 traits that are in the DNA of the companies that have become unicorns. Number 1, they radically changed their business somewhere along the way. Number 2, they said no to the wrong investors. And number 3, they said no to the wrong offers. Now, that takes a lot of bravery to do. It's very hard to do. It takes an extraordinary founder, but maybe you are that founder. They're rare, but that's why they call them unicorns.